Good morning, everybody. Mike Tedeschi, investment strategist over at Perspective Wealth Planning. In this week's video, we're going to be taking a look at the major 4 U.S. indexes. We're going to take a look at what has happened in the past. We've had such a strong start for the year throughout the months of May to October. We're going to be taking a look at the breadth readings of the overall market, and we are going to start off by actually taking a bigger picture look and pull this back out to a monthly chart. Now, we've had some volatility here over the past couple of weeks with some strong selling in the indexes earlier this week. They may have found a temporary bottom, and if we back this up and we look at this on a monthly chart, the selling stopped actually right there on that white line, and that is the 10-month moving average, and that's a very important line of defense on a longer term chart. Now, the reason I have this boxed off is one of the ways that we could take a look at the market action since the 2016 till now is this is just a multi-year base pattern before we make our ultimate next directional move, and this could similarly be viewed sort of as this right in here. Now, this range is larger than the range back from 2013 to 2016. But you can see, I mean, multiple tests of a low inside a particular range before ultimately making a breakout. And that is that box that we're trading in right now. So while over the last couple of weeks, things may have seemed difficult, when we back things up and look at a bigger picture, things don't nearly look as negative. Now, let me throw the 200-day moving average on here. You can see we are still above the 200-day moving average on the S&P 500 here. We are now below a declining 10 and 20. Those things are lined up on a negative structure, meaning the 10 is underneath the 20 moving average. The 50 moving average is above us at the current moment. So the moving averages are still not aligned. We did not make it all the way to RSI being oversold like we have the last couple of times where we've had sharp sell-offs before large bounces. So could there be a little bit more downside pressure here? Absolutely. The zones that we're really going to want to pay attention to is that 200-day moving average all the way back really to this zone right in here, about that 2720 zone on the S&P 500. That's what I view as the most important zone, really. If we look at it, we have resistance up here, major support down in here. We break underneath of that, we'd be looking then really at 2600, and then really the next level of support's all the way back at 2350. We come in here and we take a look at the Nasdaq. You can see the lines of importance that we've got drawn on the chart from last week, and I said that the very important level that we needed to hold really was that 7360 zone, and you can see we came right down to it, and that's where we bounced from. Now, I want you to remember, guys, these white lines, price action is support, and resistance is not a number, it's a zone. So really, if you want to take another look at how this is, support is really from here to here. Okay, so the fact that it broke underneath of that white line and then bounced didn't mean that the support failed up here. It pulled back into the support zone. It is a zone, it is not a number, and that's really the way you should think about the markets as a whole. It doesn't reverse exactly on a dime at a particular number. It's going to be a zone where you're going to see that price action, that support play an important role. So for now, the Nasdaq has held on to that support zone. Next zone of support really comes back into here, just underneath the 200-day moving average. Is really, this is that zone of support, and then really there's not much again until way back down here at that 6,000 zone. When we take a look at the Russell here, you can see the lines that we had drawn from last week, right? The important level is 1500, did not break below that, and it is holding up. However, it is below the 10, the 20, the 50, and the 200-day moving average. Russell has been the weakest. It has stayed the weakest. It continues to be the weakest index. I think it's very important what happens here. I don't see how the Russell could break underneath 1500 and the rest of the indexes act fine for the rest of the year, right? I think this could be a very telling zone of the market in terms of risk on, risk off type of behavior. Last but not least, we'll take a look in at the Dow Jones here. All right, here's the lines that we put on these charts from last week as the important levels to hold. It was actually below the 200-day moving average on the Dow Jones where that support zone was, that low that was put in back in March. Where did it come down to? Right there, and currently it's holding on to it. So when we look at all the indexes, even though we had a pretty ugly start to the week, we subsequently made a little bounce there. Tuesday, Wednesday have held the key levels of support across these indexes, so we can't look at this and say by any means that the bears again have won, so to speak. Yes, we have a potential double top on these indexes, but that major level of support across all 4 indexes is still intact. Now let's take a look at some actual data points. Found very interesting here. So go back in the first 4 months of the year, if you have a greater than 14% return on the S&P 500, what happens on average during that May to October zone? Now in 1967, 75, 83, 87, 98, and 2019, we had a start to the year that was greater than 14%. You can see we were right there kind of in the middle of the pack at 17.5, right? Upper end being 75 and then almost a 30% return. And right there in the middle of that zone is really around that 16, 17%. When we look at the May to October returns in 1967, we saw a negative return. In 1975, we saw a 2% gain. In 83, we saw a 0.5% pullback. In 87, we saw a 12.5% pullback. In 98, we saw a 12.5% pullback. But what's interesting is during this, almost all of them had bigger pullbacks, right? So that was the actual return. The max drawdown during these was much larger. 67, it was 6.5%. Even 75, it finished 2% positive during that time frame. It had a 14% loss in there. 83 had a 7% pullback and finished about flat. 87 a 33% pullback and came back to only negative 12%. 98 negative 13% or almost negative 19% came back and was only down 1% or so. So the question is what's going to happen here in 2019, and what you can see across the board is really much deeper pullbacks and then some big bounces. So if you think through the way in which the market works, right, we have a huge move forward. Then we get a correction, and then things bounce and continue higher, right? It's that 2-step forward, 1-step back type of behavior. And so, of course, when you have such a strong move in the beginning, the likelihood is that at some point you're going to have some sort of a retracement, and that's kind of what we've seen here over the first couple of weeks. So I thought this data was interesting enough to share with you guys. Now, fund managers are getting very nervous up here and have been. All right, this is a Bank of America survey where we take a look at fund managers and what percentage of them saying that they've taken out protection on their portfolios. Now, if it's above that 35% annualized, we see a negative 9% return, right? And if less managers are taking protection out, you see much better returns, right? And so that, of course, is a concern where we're seeing a high level of protection being bought from the smart money. So we'll have to continue to monitor that, but that is an interesting way of looking at things here for sure. Next up, we're going to take a look at the Nasdaq McClellan Summation Index, or the NASI. This is something I look at to see whether the market has headwinds or tailwinds associated with it. Down here at the bottom, we actually have the Nasdaq on the chart as well, so you can see what the reaction is with the Nasdaq McClellan Index and how the actual Nasdaq itself is acting. Now, we've gone over this in the past, but you can see when the black line goes underneath of the blue line and turns red, this right here is where we have headwinds, right? And this is where we had that crossover last September. Now, it took a month before the Nasdaq really fell, but you can see essentially the NASI gave a sell signal or a be cautious signal back here, and then we had this major sell-off. And then it crossed back over right around here. We had a little bit of a bounce, had a difficult time here, crossed back over. We had another little bounce right here, and then we got that clean rollover, and we rolled over down in here. Then we got that crossover at the beginning of 2019 with tailwinds, and we didn't have that turnover until right in here, and that's where we first saw a tiny little bit of a pullback. Then we've kind of grinded sideways, and now we've got a sell signal that generated right here, and we've had that sell-off. So when we look at this, what we look for is, do we have headwinds, do we have tailwinds? And when I see the red line underneath the blue line, it gives me caution. It makes me be a little bit more cautious. It doesn't mean that we're immediately going to fall off a cliff or anything like that, as you could clearly see from how this has worked over the last 9 months. But it gives us a reason to kind of look at things and be a little bit more concerned. Essentially, breadth readings underneath the surface are not as strong. And when things are not as strong, right, we tend to have pullbacks, corrections. And when breadth readings are very strong, we tend to have a much safer ride up, so to speak. So I hope you guys found this video helpful. I think next week's price action here across the overall markets is going to be very, very important. If we can hold some of these important levels that we have so far held after this sell-off and get back up towards those highs, then we don't have too much of a concern. However, if we break all of those key levels that I've laid out in the last 2 weeks video on all of these charts, if we break those levels and we start to head lower, then maybe that saying sell in May and go away will actually come to fruition this year. As always, I'll see you guys next week. Take care.